Hey traders, welcome back to another Sunday video where we prep for the week ahead. And in today's video, we're going to be discussing indices, commodities, currencies, and more from a technical and macro perspective. We'll talk a little bit about the economic data that we got last week, as well as some of the price action setups that I'm seeing in markets now. All I ask as we get started is that you hit the thumbs up button and subscribe to the channel if you are new. Let's jump right into it. So first of all, when it comes to the S&P 500, which is going to be a bit of our risk on versus risk off indicator to a degree, if stocks are being bought, we call this more of a risk on type of environment. And when stocks are being sold, we call this more of a risk off type environment. Last week, we saw an interesting move in terms of price action. We saw Monday move lower, and then Tuesday we shot higher off of the cool CPI print. And then Wednesday, Thursday, Friday, pretty much a wash where we just sort of traded sideways. You can see really most of the gains came from the CPI report, which was arguably considered cooler than expected. The reason I say arguably is because core CPI was actually a little bit hot, and producer price index numbers were actually hot too. We'll get into some more macro in just a second, but let's talk price action for the S&P 500. Clearly, we are still in a very upward dominated trend. You can see there is just no way to slice this and make it too much of a bearish chart. It is straight up, a very, very strong and resilient stock market here, and it has been since those April lows where we turned around on that big announcement that tariffs were going to be paused by 90 days. The reason I think this was so big with hindsight in our favor is that since then, that's been the narrative of the Trump administration is, they came out swinging initially, and then it was, okay, we're just making deals, we're negotiating pauses where we need them, etc. And the market was way happier with that type of administration rather than the, all or nothing trade deals now, demanding kind of nature that first came out the gate. So the markets have been mostly, we've really seen that narrative around tariff stuff dry up. From a technical perspective, we had a really strong bounce from that NFP freak out that we had, right? So this was NFP where we freaked out. Markets have continued to push higher since then. We do have some noticeable support where we essentially ripped through on CPI. I would not be surprised if we do come back into this area, unless you have some sort of substantial catalyst that really starts to break support levels. The path of least resistance to me on the indices is higher. However, it doesn't necessarily mean that the risk to reward is incredibly attractive to me at these levels. Sure, there may be a little bit of an opportunity, risk to reward wise to maybe try and catch another swing higher, but there are some things that are very concerning to me on the indices that I wanted to discuss in today's video. We'll get into that when we talk a little bit more macro side, but let's keep going with some more technical setups. In terms of S&P, path of least resistance to me is still bullish if you get pullbacks. I like, however, a pullback to this 6220 or even more so the 6100 to 6120 level. If we zoom out a little bit and take a look at the daily chart, I would be more of an interested buyer at this level or this level than I would up in these areas, just because you're talking about, again, a stock market that has run really hot for some time. And oftentimes when everybody gets very euphoric, we do tend to see kind of these sharp, excitable moves lower. So I'm a little bit cautious at buying at these levels. I also, to be clear here, do not have any S&P 500 or NASDAQ bullish readings within the Edge Finder. So at this time, I would actually be passing on taking buys unless we got a further dip and then the score shows up here in the Edge Finder that looks a little bit more attractive. I'll talk more about indices in a second, but let's take a look here at something kind of interesting with the US dollar. So if I pull up the US dollar, the US dollar had a really rough week last week. In fact, we moved lower after everything kind of was said and done. We saw the CPI report really took a toll on the dollar reversal that we saw midweek. And then we saw some follow through here. Yes, we got a little bit of an uptick in PPI, but it still wasn't enough. Retail sales numbers came out on Friday, and ultimately the market just continues to push lower for the dollar index. So when I'm looking at DXY on the daily chart, what I'm getting here is just sort of a choppy to downward grinding market that has been the theme for most of 2025. But why is the dollar, and also why is the dollar, kind of macro wise weak, and what's going on with the stock market? Why do I think it may actually have room to pull back? Why isn't S&P 500 a bullish reading? Well, I'll tell you, it's the economic score that's holding it back. And I wanted to show you something really important here. So what I'm going to do actually is, first of all, before I get into that, I thought this was worth mentioning on the US dollar. By the way, if you have the Edge Finder, I changed the COT data history. I made it so that you can actually select dates. So if you want to go back and look at historically what was happening in the commitment of traders data, you can adjust this to whatever your heart's desire. So for me, I'm just going to keep it on the default, which is 6 months back. And look at this. There's still some selling going on in the DXY. The US dollar institutions still seem to be adding on more short positioning on a trend basis. Now, in the latest week, they had a small amount of buying that went on in the dollar on a net basis. But again, think about it this way. The trend here for institutions seems to be still bearish on the US dollar. We see them accumulating short positions, reducing long positions, and that's what's causing these bars week by week to go more and more red. So institutions seem to be on the bearish side of the dollar. Let's keep going because I also want to show you gold here just for reference while we're taking a look at COT data history. You can see there is still some accumulation going on in gold. So institutions seem to be on a net kind of trend basis. They seem to be buying gold, selling dollar, and let's take a look at SPX because that's also worth adding into our discussion. Well, there seems to be more selling going on here. And this is really interesting because, yes, you have the stock market at all-time highs, but you see some institutional selling activity as well. Now, we have to be fair, though. There's also some accumulation on the NASDAQ. So a bit of a mixed picture COT data-wise on institutional activity. You have some bullishness with the NASDAQ positioning and some bearishness with the S&P positioning. We could continue this theme and take a look at the Dow Jones, where you did see overall, kind of downward trending here nature on the Dow Jones recently. So institutions selling Dow, and finally take a look at the Russell, another index, some selling here. To me, this shows me that, okay, institutions seem to be accumulating short positioning on the indices. And that's what it brings me to our next section here, which is the U.S. economic data table. And I made some changes to this. I actually removed the housing data from the score because I think that, while housing data is useful, it to me was not worth keeping such a strong amount of the scoring of this page dedicated just to housing. Anyways, let's talk about the U.S. economic heat map because this really tells you guys where my head is at in terms of positioning. I mean, really, you could just take a look at this and this is going to tell me my bias fundamentally or macro-wise on stocks and U.S. dollar. So if I take a look at this, so let's just analyze what we had this past week. So if we're talking about retail sales numbers came in and they missed expectations just slightly. There were some positive revisions, but we're going to keep in mind just the latest available data for the current economy. Okay, CPI. CPI came in light. That was good for the stock market. It's negative for the dollar, right? Soft inflation means less rate cuts. Less rate cuts means weaker dollar most of the time. The producer price index. Producer price index came in way hot. Like this was really hot. That's not good for stocks, right? This actually is to me, a big warning sign about inflation. That's a huge spike. We expected 2.5%. We got 3.3% year over year producer price index inflation. That was nothing to ignore. And it seems like the market sort of did and then, kind of calibrated a little bit on Friday. But that's to me a bit concerning. We also had PCE numbers, not this week, but recently, which came in a little bit higher than expected. That's bearish for stocks, bullish for dollar. Wage growth, we also had a slight tick up, which in the latest, August number for the month of July, wage growth was a little bit high. That's bullish for both, right? Take a look at unemployment rate. Unemployment rate's a neutral, right? Came in as expected. Jobless claims came in a little bit better than expected. That's bullish for both. Job openings, right? Job openings came in a little bit soft, bearish for both. ADP and NFP, one bullish, one, the big one, NFP, very bearish for stocks and for dollar. So the net aggregate here, what we can do is we can look at the macro data summary calibration here. You can see we're getting a 42 and 50% score respectively on the U.S. economic heat map. This is dangerously low for a stock market, in my opinion, that is at all-time highs. And I want to simplify this further, guys. We're talking about inflation that seems to be sticky or sideways to up, and we have jobs data, which looks sort of like it is just weakening a little bit, right? You have job openings weak, NFP weak. unemployment rate is flat relative to expectations, but did on a nominal basis go up, right? So it went up from the previous. So to me, it's like, okay, you've got some weakening data in the jobs reports. Inflation is staying sticky. And that to me, you also have growth, which is mixed, right? Let me show you our growth. Growth is mixed because PMIs look rough, right? Forward-looking indicators, PMIs look rough. GDP statistics did come in better than expected. Retail sales looked worse than expected. So we could argue that our growth score is even negative. So to me, what this shows you, what do I do with this environment? With inflation up, jobs down, growth down, that to me tells me I need to be very cautious with my stock market positioning specifically. So when I go back to the indices, that's what I wanted to show you on the macro side, is I think that has some potential to continue to roll over the stock market in this current time. Now, of course, the market is in up mode right now. People are excited. Stocks are going higher. It could go up for a while, but to me, I'm very much willing to sit on the sidelines and be patient with that. By the way, if you are not in our Telegram channel, we just announced a winner for our giveaway that we did this past week. If you didn't get a chance to join the giveaway or enter in, we do giveaways every once in a while, not very often, but we did a giveaway. If you want to join future giveaways, or if you want to, we're handing out some 30-day trials to the tool. If you want to try out the software that we just got done using, the Edge Finder, consider joining our Telegram channel, which will be linked in the description of this video down below. I'll also try to pin it in the comment section so you can conveniently grab it there. Or actually something cool we could do is you could also grab it from the QR code here. If you're watching on a television or from your computer, just to make it easier for you to join the Telegram, we've got a QR scanner if that's something you prefer. And if you do use the QR code, somebody tell me if they used it, that would be cool. Because I don't know if people use the QR codes or if it's even useful. But anyways, join the Telegram channel, because not just for that, we also have just a ton of value. We do a ton of research and share it within our Telegram. It is probably the best spot, readable content-wise, to stay up to date with our analysis and things that we're doing in markets. Also, I wanted to show you this. So this was the put-to-call ratio score or discussion that I want to get into now. So the put-to-call ratio, right, which shows you options flow. We can actually pull it up. We've got the Edge Finder. Why not use it? So if I'm pulling up the market sentiment tools here and I go to put to call ratio, what was really concerning to me is that this week you had, despite some economic data that has been really lackluster in my opinion, here's the challenge. The challenge is that the put to call ratio is showing an extreme level of greed or huge call demand. So people right now are buying calls. They're going out and they're buying calls. Stock market's going higher, buy calls, on everything, buy calls on the S&P, buy calls on, individual stocks, etc. There's a little bit of euphoria out there. So in my opinion, this is a little bit of a warning sign too, that we may be nearing a short-term top. And I'm not necessarily calling for some sort of huge stock market correction or massive sell-off, but I do think it's very much possible that we get some sort of corrective pullback in the coming weeks. We'll see if I'm right about that, and if I'm wrong, I do still have a good number of stocks that I own, individual stocks. In fact, I track it in our Trade Tracker. This portal is available to members of our Discord who are VIP. If you are interested in that, there will be a link in the description down below. You can see all of the Forex trades that I'm in, as well as the stock trades that I'm in. And you can see I've had some crazy returns on some individual stocks like Robinhood, Meta, Delta Airlines, Amazon, Tesla. So these are stocks that I bought during the April sell-off. A lot of you guys may remember I discussed that heavily on my channel at that time, how I was buying individual stocks that I liked for the longer term, and it ended up being one of my better plays this year. So I do have a lot of individual stocks, a lot of things that I'm doing on the option side as well. If you're interested in that kind of thing, selling covered calls on stocks that I own, because I do think that the market is a little bit frothy, a little bit expensive. So I've chosen, what you'll see here, is to sell a covered call on many of my positions that I currently have. So that is kind of my existing exposure. Like I said, this indicator, what you're looking at here, my positioning, you can track all the trades that I'm taking in this portal here. by becoming a VIP member. If you're interested in doing that, you also get access to all the trade alerts that I'm sharing. So I'll just show you here for context what that looks like if you're interested in that. So you can see every trade that I'm taking in full context and detail. So if I go long, like this is back in July when I took a trade on the Russell, right? If you want to check out the Russell, if you want to see the Forex trades that I'm taking, you can see all of my positions there. So everything that I take gets shared inside of the Discord, and along with it, you can also track it in the portal to see trades that I'm currently in. So if that is something that you're interested in, if you'd like to take advantage of the VIP group, we'll do a 40% off just for a limited time using the link in the description down below. So check it out if you're interested in that. All the information for the VIP group can be found down there. So with that said, let's keep going. Take a look at something else like, for example, gold. Now, gold is interesting to me because if we take a look at, first of all, what does the put to call ratio say on gold? Wow. Okay. So there's huge put demand on gold. That I'm glad we just pulled that up. Look at this. Put to call ratio went off the chain here for gold puts. People buying bearish bets on this asset. So if we go to our top setups page, that's actually even more bullish to me on gold. We already have a very bullish reading within the Edge Finder's top setups score. All this is doing, by the way, is it's looking at sentiment data like what we just looked at, the put to call. It's looking at things like the technical readings, like momentum in the chart, seasonality, etc. And it's looking at economic data, which we just looked at with the dollar being pretty soft. We're seeing some good economic scores, some technical scores, and sentiment scores in favor of gold. The only issue with gold is that it is still very much a choppy market environment. I like gold in two scenarios. I've said this many times on my channel. I like a pullback into this area of support around the 3260, 3280 level, somewhere in here. I like the possibility of a long from there, or a breakout if we can see some constructive higher highs. I am very much a fan of looking for longs in that move as well. In fact, I feel pretty good about metals in terms of at this current environment, because remember what we just got done discussing with our economic heat map. We were talking about how essentially you have people out there who are, or there's like a lot of euphoria around the stock market, but you have a situation in which you have retail sales kind of coming in a little bit soft, right? Growth metrics a little bit soft, inflation still sticky, and overall you have jobs data that's mixed to poor. So you look at that, and to me, that's an environment where people may actually move to metals in a bigger fashion. Now, we've been in a choppy sideways market, and so again, I don't like the price action here, but a swing back to the low end may be enough. I actually played it this way when it made this move back here. I ended up trailing out when we failed out through the highs. But I'd be interested in maybe playing this one again, looking at gold on the long side only right now. No interest in shorting it because again, I think the macro favors more upside for gold than downside. Let's take a look at some currencies. In fact, we can just go back to our top setups indicator here for just a second. But before I do, let me also make sure to mention today's video sponsor, which is Vantage. If you are looking for a better brokerage, check out Vantage. There's a link in the description down below. They currently are one of my top picks for international brokerages because they offer some really great trading fees. They also have a copy trading platform, and they're offering subscribers of my channel a generous welcome bonus with the link specifically found in the description of this video down below. So if you're interested in checking out Vantage, like I said, all the information for them can be found below. You can explore them. If you're looking to trade CFDs on anything, NASDAQ, S&P 500, gold, individual stocks, they've got a huge list. So check it out using that link in the description if you are outside of the U.S. If you're in the U.S., unfortunately, Vantage is not an option for us U.S. traders, but check them out if you're interested and outside of the U.S. Okay, so let's talk some currencies. So if I go back to our top setups page for just a second, what we have here is some dollar weakness, dollar Swiss, dollar yen, and dollar ZAR getting some bearish setups, and then euro dollar getting a bullish one. So a couple dollar setups that I wanted to discuss with you guys. Let me just close this trade tracker page. So if I'm looking at the euro dollar, for example, to me, this one would be attractive on a dip buying opportunity. So if you got a pullback into 1.16 or so, if you got a pullback into 1.145, this also looks attractive to me for possible longs. I do like the upside for the euro dollar and think that, if you do get a dip, I think it will likely get bought. I think the dollar is still just fundamentally, it's just soft this year, and there's a lot of momentum in favor of moving out of the US dollar. I think that can continue a little longer than people may expect, though the dollar has been really weak this year. It doesn't mean that it can't keep getting weaker. Same thing so I do like euro dollar to the upside on pullbacks. Dollar yen may be one to keep an eye on. Very bearish looking chart in my view. I think you've gone sideways for a few months, but you've really topped out, in my opinion, likely around these areas. I think this is one big kind of longer term level of selling that we may see. I also think it's interesting to keep an eye on the institutional data around the yen. So if I pull up our COT data history, let's look at the Japanese yen. This year has been interesting. We had seen a really big accumulation of the Japanese yen, and since then we've actually seen a little bit of bearishness. So this takes a little bit of my conviction away from being bullish yen. However, again, we have to take it into consideration the full picture. So if we take a look at sentiment, right, COT data is a little bit more bullish for dollar yen, right, based on what we just looked at. You can see why the scoring algorithm already picked this up for us. Well, it looked at it and said, well, they're basically selling yen, so that's bullish dollar yen, right? So that's what the software just did automatically for us. But that's not the only thing we look at, right? So sometimes people say, well, how can you be bullish on something when the COT data looks different? And the reason is because I don't overvalue the COT data. It is valuable, but in its entirety, that's not the only thing I'm looking at, right? I also want to look at economic data, which heavily favors the Japanese yen on a relative basis to how the market has performed, or how economic data has been coming out relative to expectations. The Japanese yen has been strong. We'll take just a look at that in just a second. Technical reading also looks pretty bearish here, as we saw in the chart. So if I'm taking a look at, for example, the economic heat map for Japan, which is what I want to discuss here, you can see that the Japanese currency, the Japanese yen, is getting some strong readings based on a number of things. You had GDP growth, which came in better than expected, right? Forecast for 0.1. Actually came in at 0.3%. So although it's not a huge GDP growth, it still beat expectations, which is what the market trades off of. It trades off of the surprise factor. And so the Japanese economy has been surprising to the upside on many key metrics that make the Japanese yen look attractive to me. So again, yes, COT data is valuable. Don't get me wrong. But is it the only thing I consider? Definitely not, right? Because COT data is useful, but there's plenty of times where institutions can be very early to an idea and accumulate for 6 months before the right move happens, right? So instead of kind of trying to use COT data as some sort of holy grail, I like to use it as a piece of my analysis. And when I start seeing fundamentals, technicals, and institutional activity all aligning, those are some of the better trades that I've been able to find. So that's my perspective on dollar yen, as I do see some more downside on this pair. I think that's the path of least resistance, at least at this time. If we go back to our top setups indicator and take a quick look here, what we can see is that we also have dollar Swiss and US oil, two setups that actually look really interesting. Dollar Swiss is sitting at a shelf here, excuse me, a shelf here of resistance that I think is interesting to keep an eye on, right? So you have this past huge level of support around 0.81. We're sitting at that area. I would not be surprised if any sort of further rate cut narratives continue to play out and this data continues to fall the way it does. I think the dollar Swiss looks soft here and could continue its downward trend. Actually, what's interesting is if you have the Edge Finder, check this out. Go to your retail sentiment, and something interesting has been happening with the dollar Swiss, which is that retail is still very, very long dollar Swiss. So to me, that produces a contrarian bearish signal. When we know retail positioning is very bullish on something, that gives us a contrarian bearish signal. So I thought that was worth mentioning when talking about the dollar Swiss franc. It's been trending lower, right? So institutions seem to be selling the dollar, and what do we hear about the retail crowd? They seem to be buying this pair. So to me, that suggests even more bearishness makes sense, at least for now. So that's how we're using sentiment, guys, is we're using tools to track what retail's doing, track what institutions are doing, and to help put the kind of the stats in our favor, if you will, or the info that those insights in our favor. having the right tools to track it is critical. So like I said earlier in the video, if you're interested in trying out the Edge Finder, we dropped a link to try it in the Telegram channel, so you can join and just get the trial here, or it's in the description of this video down below. But definitely try out the Edge Finder if you have not already. It's a remarkable tool, if I do say so myself. We've spent the last few years developing it, and it's come a really long way. So anyways, let's take a look at U.S. oil, because that was another one that I'm really interested in possible shorts. You know, last week we had some inflation data that, or I'm sorry, some NFP data, and then CPI data, PPI data, retail sales numbers, and the cards kind of fell in a way that pointed towards more bearishness in the economic data segment. You can see -6 score in economic data, which what you'll also notice is economic data typically has the strongest pull in the Edge Finder. The fundamentals, the macro suggests, strongly which direction something is, going to get a bias on, which is ultimately what a lot of people use the Edge Finder for. Is it's a fundamentals screener and a sentiment screener. Most people can figure out technicals. That's why technicals don't get a huge amount of allocation to score, and really it comes from the economic data and sentiment data as a collective. Anyways, what we can see here is that oil getting a bearish reading, -8 overall. That to me is a sell on any strength. So again, that's could be, no guarantees that that's going to be, a perfect sell. Nothing is a perfect guarantee of future price action. Markets can change, at any point. If Putin and Trump, get in it and they start fighting about something, oil can go crazy. So there's no way to predict that. But just considering the macro, the current situation, the path of least resistance, which is all I'm after, the probabilities here for me look attractive around the 66 level for a possible short opportunity on the oil market. So I am looking at U.S. oil at a pullback here, looking for possible shorts to get set up into. And I'll keep an eye on that going into this week. So keeping an eye on oil prices as a possible setup for the week ahead. That's going to be it for me here today, guys. If you enjoyed my commentary, if this was helpful to you in any way, shape, or form, do me a big favor, hit the thumbs up button, subscribe, and have a great trading week ahead. Thanks for watching.